start, I'm going to show you a very important notice that I'm expecting you all to read word for word. It is important because obviously stock market investing carries risk, and no more so as this has been more evident in recent weeks. But as we always say, our job is not about timing the market, but spending time in the market. And hopefully, I'll be able to explain a little bit about the background to Witan Investment Trust, and give you an idea for how it is that we manage our shareholders' money. So just as a brief introduction, we are an investment company listed on the London Stock Exchange. We were founded in 1909, one of the oldest investment companies, and we were founded to look after the assets of one family. We now have over 25,000 shareholders, the majority of whom are private individuals, either investing directly or through platforms. And we have assets of 2 billion sterling and are a member of the FTSE 250. So, what is it that we do and how do we do it? We like to think of ourselves as a one-stop shop for global equity investment. We do this by investing in a range of global equities through what is called a multi-manager approach. So what we have is an in-house team that is employed by Witan. I'm one of those. And we select a range of managers whose job it is to pick the individual stocks within the portfolio. We currently have 8 managers in the lineup. It's an actively managed investment vehicle, and that means that our managers are free to choose from whatever stocks they like within their chosen mandates. We're not passive investors. And as I say, we're self-managed. So we have 6 individuals who are responsible for the management of the portfolio. Crucially, Witan is independent. So the vast majority of investment trusts are managed by an asset management house. Many of the well-known names, obviously, that you will have come across. We are independent, which means we're self-managed. It means that we're dedicated to our shareholders. It also means that our outlook is aligned with the outlook for the shareholders. We have a highly experienced board of directors. Jonathan and Simon talked about the advantage of having an independent board of directors. We have 7 independent non-executive directors, many of whom have financial markets and investment management experience to help us drive the investment decisions forward. And we have, as I said, the investment team that's responsible primarily for overseeing the manager selection and monitoring of the portfolio. Crucially, this third point here, our assets are held in segregated mandates. That means that we own the assets. We don't invest into funds. So when you have incidents, for example, such as the demise of Woodford Investment Management, those funds were all gated and closed, so nobody could get their money out. That is not the structure that we operate. So the managers that we employ manage portfolios that are held in our custody, so we always have control of those assets. It also gives us tremendous insight into what the managers are doing. So we like to call this collective wisdom. Now, I'm sure that many of you will not know what the word Witan means. I didn't really know what the word Witan means until I joined Witan in 2015. A Witan is the Anglo-Saxon Council of Advisors to the King. So we like to think of this as collective wisdom. So at the top of the collective wisdom sits the board, and I'm delighted actually that one of our board members is here today, obviously overseeing activities on a Saturday as well as Monday to Friday. The board of directors are collectively responsible for the strategy of the company and for the success of the company. They are the ones that set the framework of controls. They're the ones who set the investment policy. They oversee us, the investment team. And it is their responsibility to protect and represent the interests of the shareholders. They delegate a lot of the day-to-day management of the company to us, the investment team. It's our job to identify investment opportunities, to select the right portfolio managers, to monitor those portfolios, to engage with the managers, both in good times and in bad, and make changes to the management lineup where appropriate. We are also responsible for a investment into a number of specialist investment funds, which I'll come on to a little bit later. We appoint the managers. The board are the ones that make the decision and the final decision to appoint the managers. The managers are the ones who select the portfolios. So each of the managers will run a very high conviction, concentrated portfolio of approximately between 20 and 50 companies in each portfolio, depending on their own chosen investment strategy. Generally, they're looking for companies with durable earnings, sustainable cash flows, and companies where their growth prospects are undervalued. And they are always supported by a broad team of analysts. So what does that give us as Witan in total? That gives us a portfolio, as you can see here, £2 billion sterling. It's invested in 8 different managers across 27 countries. That's companies domiciled in 27 different countries, across 11 sectors, 24 industries, and we also have investments in 11 specialist funds. 262 companies in total, and the number there, 79%, that's the active share. For those of you that don't know, active share is a measurement of how different your portfolio is from a global equity benchmark, let's say, for example, the FTSE World Index. So a number of 100% is it's completely different, and a number of 0 means it's exactly the same. So our portfolio is really very different from a typical global equity benchmark, which really differentiates us from what you might be able to find in a tracker fund. Moving on, just to give you an idea of some of the holdings within the portfolio. Now, these have been selected from our top 20, and they've been selected really to give you a flavor of what sort of companies sit within our portfolio. And the way we think about our portfolio is core and specialist. The core portfolio is managed by 5 managers who have global equity portfolios, plus 1 that has a UK portfolio. And those portfolios give us exposure to companies such as Heineken, Google, Taiwan Semiconductor Manufacturing, BAE Systems, obviously a company that's very much in the press at the moment, having performed exceptionally well on the back of demand for defense and armaments manufacturers. Unilever is also in the press at the moment for different reasons. Unilever is a company that's been going through a bit of a torrid time over the last 12 to 18 months. So that just gives you a flavor of the core portfolio. There are about 200 companies in the core portfolio. Specialist portfolio. Why do we have a specialist portfolio? Well, as you can see, most of the companies within the core portfolio are some big global mega cap, large cap, mid cap names. But we believe there are lots of opportunities in the investment world that are outside those spheres. And so when you appoint managers who specialize in investing in those sorts of companies, they might not be able to take advantage of the more specialist parts of the market. And that's where our expertise comes in. We're able to select a number of specialist investment companies, many of them listed on the London Stock Exchange. Some of them you may have heard of. Syncona is a biotechnology, early stage biotechnology company. Victory Hill was one of the companies that was actually on Jonathan Simon's slide earlier. A new issue in the London market, targeting growth in sustainable energy opportunities. Apax Partners, listed private equity. We've got about 5% of our portfolio invested in private equity. And then GMO is a climate change strategy. We believe there are significant tailwinds behind the investment opportunities in climate change, or addressing the impacts of climate change. This gives you a brief idea of the breakdown of the portfolio. So you bring all those companies together, and there's a geographic spread there, and obviously a sector spread, so spread across all the sectors within the investment universe, and across all the regions of the world. Obviously, the largest exposure being to North America, followed by the UK and Europe. It's important to note that this isn't a decision necessarily that we take from the top down. The asset allocation is the result of those stocks that our managers pick. And so our asset allocation is driven by that. We, as an investment team, have the ability, and sometimes use that ability, to alter our asset allocation if we feel it's appropriate. And that is one of the tools that we have to be able to drive performance. And again, Simon and Jonathan spoke about many of the advantages of the investment trust structure. We use them to the greatest possible extent. One of the advantages is obviously the ability to gear. And as a large investment company, we're able to borrow money at a fixed rate at an extremely cheap price. Just to give you an idea, we currently have borrowings of about 155 million sterling against a portfolio of 2 billion. And we've borrowed that at an average rate of 3% fixed over the next years out to 2050. So very long-term fixed rate debt. We believe that's a very attractive structure because we're able to invest that money at yields in excess of that and obviously be able to generate capital growth as well. Obviously, gearing is a double-edged sword because it gives you improved performance in up markets, but obviously in down markets, you can see here in the chart on the right-hand side, the blue bars indicate how accretive to performance the gearing has been, and obviously there have been a couple of years in the last decade where it's been negative. But if you look at the S&P performance, just to take an example, over the last 50 or so years, 75% of those individual years have been up markets. So going back to what I said at the beginning, it's not about timing the market, it's about spending time in the market. Crucially, obviously the cost of borrowing at fixed rates has come down dramatically over the last few years, and we took that opportunity to lock in low interest rates. Obviously, interest rates now look like they're on the turn, and securing those cheap borrowings wouldn't be so easy going forwards. We also have short-term borrowings that we can use to vary our level of gearing depending on the market environment. Discounts, investment trusts do trade at a discount and premium to asset value. When our shares trade at a discount, we will buy those shares back. The board has a long-stated ambition that our shares should trade at a sustainable low discount to asset value. The advantage of being able to buy shares back is it reduces the volatility of the share price and also is accretive to those shareholders who remain invested. So, for example, last year we bought back 8% of our shares in issue to the benefit of our shareholders of about £11 million. Just to put that into perspective, that is much more than we paid in fees to our external asset managers. We can use other things to vary our asset allocation. We sometimes use ETFs, we sometimes use index-traded futures to increase or decrease exposure to various markets, such as the US, Japan being an example a few years ago, because a lot of our managers didn't own many Japanese companies, but we felt there was an opportunity, short-term opportunity to increase exposure to Japan. And revenue reserves. One of the great beauties of running an investment trust is that we're allowed to squirrel away some money in each year to be able to enhance dividends or protect dividends in future years. And here I've got a chart that shows you the power not only of buying good, sustainable companies that grow their earnings over the long term and increase their dividends year by year, but also the beauty of an investment trust structure. So what we can see here is the blue bars, the blue columns are our dividend in pence per share every year going back to 1975. 1975 is not a random number. 1975 is the last time that Witan did not increase its dividend. So you can see the dividend growth rate, which is this pink line here. So our dividend is roughly 70 times what it was in 1975. And the green line there is the dividend of the FTSE All Share. So obviously grown the dividend at a much, much slower rate. And also you can see here in the COVID crisis, for example, the dividend payout rate of the FTSE All Share declined by about 25%, whereas our use of revenue reserves, we were able to maintain a growing dividend. And we still have significant revenue reserves in place to be able to support dividends going forwards. So a really crucial and beneficial aspect of the investment trust structure. But it's not just about the structure, it's about owning good, sustainable businesses that can pay dividends over the long term. Talking about sustainable businesses, I'm sure you'll all be aware that responsible investment and ESG are an extremely hot topic, pardon the pun. Global warming obviously is a key issue here, and we believe that it is also a tremendous investment opportunity. So a risk and an opportunity. The opportunity, you might wonder what that is. The opportunity, we believe, is in a number of companies that are well placed to benefit financially from the world's efforts to mitigate or adapt to climate change. It's one of the reasons why we've invested in a sustainable energy fund. It's another reason why we have approximately 5% of our assets invested in a climate change strategy. Now, that strategy doesn't just buy clean technology companies, it also owns things like mining companies, because copper is crucial to the transition to low carbon energy. So very strong long-term tailwinds, we believe, from our global effort to combat climate change for some of these companies. But what does this mean for us as Witan, responsible investment? We believe that it fits very much in with the slide that I showed you previously about the dividend growth. If you own companies that are durable, that have sustainable long-term growing cash flows, you will, as a shareholder, benefit over the long run. But, and this comes down to what we believe is the crux of responsible investment. It's not about sacrificing returns for the sake of doing good for the planet. They go hand in hand. So, what do we mean? We mean that we look for companies, or we ensure that our managers are looking for companies that have enduring cash flows, that exhibit good corporate behavior, that treat their stakeholders well, and they treat their shareholders well. P&O is not a listed company, but I would be very surprised if P&O emerges unscathed from their actions that they took over the last couple of days. And that is what we mean by good corporate governance and treating your employees and your shareholders well. If it had been a public company, I would suspect the share price would be significantly lower on Monday than it was on Friday. Strong management then. Then we've got the issue about the planet. We expect all of our companies to have a carbon reduction target in place and, where possible, try and attain net zero by 2050. This isn't just a sort of us wanting to be the collective conscience of our shareholders. It's about what we believe, that companies that don't behave well, that don't move towards a lower carbon economy, will be at risk of litigation, regulation, and financial damage over the coming years. And obviously, if there's a change in government in this country, that's likely to increase. So, for example, if you own fossil fuel companies, there will be likely increased levies on those cash flows. So dividends going to shareholders will be impacted. So in summary, what our purpose is to try to achieve a significant growth in wealth for our shareholders. And we believe that investing in sustainable businesses with sustainable cash flows, through an active management approach, with us having the ability to access specialist opportunities, is the way to deliver on that purpose.
A nice, stable share price is a thing of great beauty, and you've managed to achieve that in addition to 47 consecutive years of dividend growth. How confident are you that there will be another 47 years of consecutive dividend growth?
Well, I think we need to be a little bit careful about talking about a stable share price, because obviously, as the chart tells you here, there are times in the equity market where the price is not stable. But the discount...
It's better than some that I've seen.
Absolutely, absolutely. I think the most important thing is to not panic and to remain invested, but obviously that wasn't advice. In terms of the 47-year dividend growth, I mean, the board has said that it is our policy to have a sustainable growing dividend over the long run. We have the revenue reserves in place that we can use to meet that target, and we can also use capital if we need to in the short term to help smooth the dividend. So we're pretty confident that we'll get towards the end of this century
And the mischievous question, speaking of the board, what would you do differently if you could start the year afresh? Would it be to stop the board stalking you on a Saturday?
What would I do different if I could start this year afresh? I would have probably bought a crystal ball. But no, seriously, I think, taking the Russian invasion of Ukraine as an example, and the horrendous images that we see day to day, I think it's just a reminder that Witan has been in existence since 1909. It's been through 2 world wars already, and has managed to survive all those periods and grow our shareholders' wealth over those periods. I think what we need to do is put this into context and say, yes, of course, the markets have had a little bit of a dip over the last few weeks, but actually, in the long term, when you look at those charts going back 10, 20, 30 years, they become tiny little blips. Even the great financial crisis or the dot-com boom and bust now sort of disappear into insignificance if you remain invested over the long run in good quality businesses.